So good morning, students. Today we are taking up the topic on bond risks. As we have seen the previous trimester regarding the stocks, equity stocks. Like equity stocks, bonds are also subject to risks. When every financial assets have got a risk, not only financial assets are subject to risk. Here today we look at what are the risks associated with the bonds. The moment we buy bonds for the company which is issuing the bonds, the bond holder who is buying the bonds. So what are the risks which are involved in this bonds? So by holding the bonds or by selling the bonds, what risks are involved? That's what we are going to look at today. So far we have seen, we looked at the price of the bond and what is the relationship between price and yield. That's what we call it, the interest rate. Then we have seen, and then we looked at the types of yield, various types of yield that we have seen. We have seen current yield, nominal yield, yield to maturity, and yield to call. We have seen that, and we looked at the case studies on all this, and then we looked at how we can calculate the forward rate for government securities that we looked at. And today we are looking at what are the various risks associated with holding bonds. Like any other investment, bonds are all subject to risks. The bond risk can be broadly classified into two broad categories. There is controllable risk and uncontrollable risk. As we have seen for equity stocks, we have seen in equity stocks market risk, purchasing power risk, then interest rate risk, and then we have seen business risk, financial risk, which are controllable risk by the company. The same way, we can classify all the bond risks broadly into two broad categories. That is controllable risk or uncontrollable risk. And controllable risk means the company cannot have any control over this type of risk factors. The moment the company issues these bonds, or the moment the bondholder buys these bonds are subject to this kind of risk. So under the uncontrollable risk, that's what we call it, inherent risk. Uncontrollable risk is also known as inherent risk, or we call it as the non-diversifiable risk. Non-diversifiable risk. One, interest rate risk. As we have seen, the relationship between bond price and yield. Bond price and yield are inversely related. Bond price and yield are inversely related. The higher the yield, higher the yield, lower the price. Higher the yield, lower the price. Lower the yield, higher the price. That we have seen. Both are inverse related. So that is the risk that the company is having it, or the bondholder is having it. So the interest rate vary depends on bond price. Interest rate vary depends on bond price. For example, a rise in interest rate decreases the bond price. A rise in interest rate decreases the bond price, whereas the fall in interest rate increases the market price of a bond. The higher the yield, higher the interest rate, lower the bond price, and lower the yield or lower the interest rate and higher the bond price. So both are inverse related. So interest rate risk is also known as the market risk. So it's a function of the maturity period of the bond and its coupon rate. So as we have seen, while calculating the value of the bond is the present value of interest rate payment and the present value of cash flow, the present value of the principal payment that we receive. So we calculate interest rate divided by 1 plus r power t plus principal payment divided by 1 plus r power n. That's what we calculate. So the higher the maturity period is very longer, the greater sensitivity of price to change in interest rate. So if you are having the bond, say for example 3-year period, 3-year period, maturity period, and a 5-year maturity period, the 5-year maturity period bond has got higher sensitivity in changing in relation to change of interest rate. And if you are having 3-year bond maturity period bond, so that particular bond is having less sensitivity to change in interest rate, because you are having this bond for only for 3 years, whereas the 5-year bond you will be having it for 5 years. So the longer the maturity period and a greater sensitivity of price to change in interest rate. And same way, larger the interest payment, you receive more amounts. For example, 10%, and then interest rate is say 8%. So 10%, if you are receiving 10% interest rate, so that means the lesser sensitivity of price changes to interest rate than the 8% interest rate. So if the maturity period is longer and then the greater sensitivity, the larger the payment, interest rate payment is very higher. I mean, you receive higher interest payment, larger interest payment, then the lesser will be the sensitivity of price to change in interest rate. So it is basically, the interest rate risk is basically talks about the relationship between price and yield that we have seen earlier. So any clarification with regard to interest rate risk? Because this is a basic risk that we talk about. Higher the yield, lower the price. Lower the yield, higher the price. So any clarification, anybody with regard to this? Any doubt, anybody? Any doubts, anybody? Any clarification, anybody, with regard to interest rate risk? So these are all the points that you need to write when we are asked to write. These are all the points that you will have to point out. That's why it is given in bullets. It's already there in LMS. You can look at in LMS. It's already there in LMS. The entire topic is there. Any clarification? Yeah.
Excuse me, sir.
Yeah.
Can you just mention the point, the maturity period and the sensitivity, sir?
Yeah. See, for example, you have 5-year bond and your 10-year bond. 5-year bond and 10-year bond. The 5-year bond is having less sensitivity. That means the interest rate after 5 years, what will change, we don't know. So after 5 years, the interest rate changes, the yield changes. So this particular bond will not get affected. So for example, 6th year or 7th year, the yield is increasing or declining due to some factors. So the 5-year bond, will not have any effect on these changes because that maturity period is over. Whereas the 10-year bond, if it is changes, any changes is coming with regard to yield due to some factors, then 6th year, 7th year, some change is coming, 10-year bond will have a sensitivity. So lower the maturity period, less will be the sensitivity. Higher the maturity period, and greater will be the sensitivity. Because, for example, 1 year, that's why are we going for depositing cash in the bank, say for 3 months or 1 year? Why not put the entire money for 10 years? Why are we keeping it for 1 year instead of keeping it for 5 years? What is the difference? I'm talking about fixed deposit. I'm talking about fixed deposit. Which is better? 5-year fixed deposit, you are keeping it, or you are going for 5-year fixed deposit or 1-year fixed deposit? Which is convenient? Which is better?
5 years.
5-year means what happens is if the interest rate, the RBI revises the interest rate. So, for example, the RBI lowers the interest rate. The RBI or increase the interest rate. See, for example, when you are depositing cash in the bank for fixed deposit, at the time, say for example 10%. 10%. Okay. So after 1 year, after 2 years, the interest rate is increased to 12%. Okay, the benefit of the 2%, this fixed deposit, will it get? Fixed deposit, will it get?
No, no, sir.
Because you don't get it. Because, I mean, after 2 years, the interest rate got increased. You don't get that benefit. You don't get the benefit of increase in interest rate because you are depositing it for 5 years. So the increase in interest rate benefit, the deposit holder will not get it. So that is, benefit you have. That's why many go for what? 1 year. So that, and even if it is for 5 years, if you want money, you cannot take it. Because it is deposited for only for 5 years. You cannot take the money in between. And if there is change in interest rate, that will not get affected if it is for 1 year. If it is a 5 year, change in interest rate, will it have an impact on that? So, that's why many prefer to go for 1 year fixed deposit period rather than 5 year fixed deposit. Got it?
Yes, sir.
The same logic is used here. Yeah, yes, Father?
The larger interest to pay.
The larger interest payment, you receive more money. When you receive more money, what is that? For example, you receive 8% interest. You are receiving, say, 80 rupees for 1,000 rupees bonds, and 12% interest. You are receiving 120. Okay, you are receiving 120. Here you are receiving 80. So when you receive more money, and if there is a decline in yield, there is decrease in interest rate, that will not have a greater impact because the interest amount is higher. You are receiving very higher interest amount. Whereas here you are receiving less interest amount. So if there is any change in yield, that will have a greater impact. The more money that you receive, that will have a less impact. And the less money that you receive, less interest amount that you receive, that will have a greater impact.
Yeah, thank you, sir.
Yeah. Okay. So these are all important points that you need to keep in mind while we are explaining the topic called the interest rate risk. Then second one is inflation risk, that the company cannot have any control over this inflation risk. Inflation, as all of us know, rising prices, increase in price of commodities and services. Inflation rate is great, as having a close association with the interest rate. Interest rates are usually defined in nominal terms, that is, say, 10%, 11%, without having any adjustments with regard to inflation. So this means that they express the rate of exchange between current and future rupees. For example, the nominal interest rate is say 12% on 1 year loan. It means that rupees 112 is payable after a year hence for 100 rupees that you borrow today. Okay, so you will have to pay 112 rupees after 1 year because you borrow 100 rupees for 12% loan. So after 1 year you will have to pay 112 rupees. So for example, the inflation rate is say 6% or 5%. Okay, so what is the real interest rate? The real interest rate what the bank receives, that is 12% minus 6%. 12% minus 6%. Okay, so the higher the inflation rate, the lower will be the real interest rate. Higher the inflation rate, the lower will be the real interest rate. Okay, so the impact of change in inflation rate is similar to that of change in interest rate. That means the inflation rate is greater for long-term bonds. The inflation rate is greater for the long-term bonds because you are holding the bonds for a longer period. So when we are holding the period for a longer period, the impact of inflation is very higher. Okay, so as the inflation is, the rise in inflation as it was mentioned earlier, the rise in inflation decreases the bond price, and decrease in inflation enhances the market price of bond. Okay, so higher the inflation rate, lower the real interest rate, and that reduces the bond price, and lower the inflation rate, that enhances the real interest rate, and that increases the market price of the bond. So in the period of volatile inflation rates, the investors will be reluctant to buy such shares. During such times, the floating rate bonds and shorter maturity bonds become very popular, because higher inflation rate means the stock price will fall. So they tend to buy the floating rate bonds. The floating rate bonds means the inflation rate gets adjusted. So the inflation rate risk describes about the changes in price of goods. So what is a real interest rate? The real interest rate means, for example, the interest rate is say 15% and the inflation rate is say 6%. What is your real interest rate? How much money that you receive? The money that you receive is only what? 9%, not 15%. Because 6% that you are paying for what? Paying for increase in price. So, you don't receive 15%, you receive only what? 6%. So for example, we talk about increase in salary. Okay, so for example, company enhances the salary for 10% or 12% or 15%. So that is not the real increase in salary. The real increase in salary is 15% minus the inflation rate. Because whatever you receive money extra, that you will have to pay for what? Increase in price. So for example, the moment you come to the petrol bunk, you will have to pay more. The oil prices have increased, petrol price or diesel price got increased. So whatever you are getting extra, that you are paying here for increase in price. That means what is your real increase in salary? The real increase in salary is not 15%. For example, the inflation rate is 5%. The real increase in salary is only 10%. Because whatever you receive, you are paying it for increase in price. We are going to the market, the price, all the price of in the market got increased, so you are paying extra there. So whatever you are receiving from the company in terms of increase in salary, here in the market you are paying extra. So what is your real income? The real income is not 15%. The real income is only 10%. That is 15 minus 5. 5 is the inflation rate, for example. In the same way here. So from the company, if you receive say 12%, 12% is not your interest rate. The real interest rate is interest rate minus inflation rate. Any clarification? Anybody? So if you are having longer maturity period bonds, that will have a greater impact on inflation. The same way we talk about the interest rate and maturity period, because that will have a more impact on inflation, because you are holding the bonds for a longer period. If you are holding the period for less period, that will have a less impact on inflation. Any clarification? Anybody regarding inflation risk? So higher the inflation, lower the real interest rate. Higher the inflation, lower the real interest rate. Lower the inflation, higher the real interest rate. So any clarification, anybody regarding inflation risk? Anybody? Any doubt? Okay. Inflation risk. The third one is real interest rate risk. Both are related. Inflation risk and real interest rate risk, both are related. So we talked about the concept called real interest rate, and the real interest rate, it's having also a risk. What is that? The real interest rate is the interest rate that takes the inflation into account. So to calculate the real interest rate, the nominal interest rate is taken first. The real interest rate is equal to, as we have discussed earlier, nominal interest rate minus the actual or expected inflation rate. Real nominal interest rate minus actual or expected inflation rate. So the real interest rate gives the lender investor an idea about the real rate that they receive after taking into account the inflation. So the real interest rate provides an idea to the lender or borrower what is the real interest that they receive after the inflation is taken into account. So this also gives a better idea of the rate at which their purchasing power increases or decreases. So the inflation rate increases, the real purchasing power decreases. So the inflation rate is highly unpredictable. So we cannot predict the inflation rate. For instance, the real interest rate falls to 6 to 4%. The real interest rate, I'm talking about real interest rate, falls from 6 to 4% because the inflation is increasing. The inflation is increasing, so the real interest rate is declining. So in this case, the company which borrowed the funds at 6% real interest rate suffers because they'll have to pay more. Suffers. So while it may earn only 4% on its assets, but it has to pay 6% on its debt. Okay, so when the inflation is increasing, so in that case, you will have to pay for whatever money that you borrowed. You will have to pay for example, you borrowed say for 6%, you will have or 8%, you will have to pay for it, but your asset gives only less interest. So hence, a change in interest rate is a source of risk that the borrower and lender have to face. So the inflation risk and real interest rate risk are closely related. So any clarification with regard to inflation risk and real interest rate risk? Anybody? Any clarification? Anybody? Any doubt? Darshita, 3108.
Yes, sir.
What is the relationship between maturity period and real interest rate inflation risk?
Sir, lower the maturity, the sensitivity will be low, sir.
Okay.
Higher the maturity, the sensitivity is more, that the bond price will affect more.
Okay. Ajit, 3133.
Yes, sir.
What is called real interest rate risk?
It is an interest rate that taken inflation in account.
Okay, interest rate that takes into account the inflation. Okay, okay. So, what is the relationship between real interest rate and the inflation rate? What's the relation between real interest rate and inflation rate?
They both are closely related, sir.
Okay, how is it closely related?
The risk in inflation rate decreases, the bond price decreases in inflation.
No, what I'm talking about is, I'm not talking about bond price. What I'm asking is the relationship between real interest rate and inflation rate. So the interest rate, the inflation rate increases, the real interest rate decreases or increases?
The purchase rate decreases, sir.
No, if the, okay. Vigneshwaran, Om Vigneshwaran, 3160. 3160. Good morning, how are you?
Good morning, sir.
Okay,
How are you, sir?
fine. So what is the relationship between real interest rate and inflation rate?
Sir, it's closely related.
Yeah, that we know, closely related.
Because when the inflation rate is low, when inflation rate increases, it will affect the bond, sir.
It will affect the bond. What will be the effect on real interest rate? So it will not affect the interest. Okay. Durga Prasad, 3167.
Yes, sir. Good morning, sir.
Morning. What's the relationship between real interest rate and inflation rate?
Sir, inflation rate is highly unpredictable, sir.
Okay.
Then the real interest rate falls to 6 to 4%.
No, that's not all I understand. What's the high? For example, the inflation rate increases. What will be the impact on real interest rate? Interest rate decreases. Okay, good, very good. Okay. Now we come to the fourth one, which is another uncontrollable risk. The company cannot have any control over this. That is called liquidity risk. Liquidity risk. Here, liquidity means the bond holder, how far he can convert that bond into cash. In case of equities, if you hold the equity, in secondary market, the equities can be sold. The equities can be sold in the secondary market. Whereas the bonds do not have liquid market. They are traded over the counter market. If you are having it, we are having the bond, that bond cannot be sold immediately as we do for the equities. Equities have got very high liquid market. If you don't have, if you want cash, you can sell in the secondary market. It can be converted into cash within 2 days time. Within 2 days, you receive the money. But here, whereas here in bonds, we cannot sell it immediately because it doesn't have a liquid market. So the liquidity is very, very less in case of bonds. It cannot be converted into cash immediately because it does not have a liquid market as the equity has. So except some of the popular Government of India securities which are traded actively, most debt instruments don't seem to have very liquid market, unlike equity market. Unlike equity market, it does not have any liquid market unless you have a government bonds. The government bonds, yes, you can. It doesn't have a secondary market, but you receive money. The market for debt is mainly on the over the counter. Over the counter means it is unorganized segment. It is unorganized segment. Unlike US debt market, US has got very liquid debt bonds market, but we do not have over the counter market, and much of the activity seem to occur in the primary and new issue market. So you buy the bonds, you keep it for 5 years or 10 years, then after 10 years you will receive the principal amount. You cannot sell it within that period, okay, unless as we have for equity. So given the poor liquidity in the debt market, the investors face difficulty in trading debt instruments, particularly when the quantity is very large. So for example, you have 1,000 bonds or 2,000 bonds. The 2,000 bonds, you bought it for 1,000 rupees. So much of money has been invested, but it is locked. You will receive the principal amount after the maturity period. You cannot sell it immediately. Okay? So they may have to accept the discount over the quoted price while selling and pay the premium while buying. Okay? Because it depends on the yield. The yield is higher. The yield is very higher. You will have to buy the bonds at a discount. The yield is less. You buy it at a premium because the bond price increases. Okay? So that is the greater risk the bondholder has got. It is not for the company. It is for the bondholders. Whereas the real interest rate or inflation rate, it affects both. It affects both company as well as the bondholder. But liquidity risk is predominantly affects the bondholders, not the company. Company doesn't worry about the liquidity risk. The bondholders should worry about the liquidity risk. The liquidity risk means the bondholder cannot convert, cannot sell these bonds in the secondary market as we have for equity secondary market. Okay. So any clarification regarding liquidity risk? So bonds have got poor liquidity. Then another important uncontrollable risk is the reinvestment risk. Reinvestment, because you receive the bonds, you receive the interest, and you reinvest those bonds, reinvest those interest in some other bonds. Some other bond. It's called reinvestment risk. So if the interest rate falls in the future, the interest payments may have to reinvest in a lower interest rate. So the interest rate falls in future. Okay. So what happens is the interest payments have to be reinvested at the lower interest rate. So this is called reinvestment risk, because the future the interest rate falls, then you'll have to invest at a lower lower interest rate. So that is called reinvestment risk. The reinvestment risk is greater for bonds with a longer maturity period, because longer maturity period bonds have got higher reinvestment risk in case the interest rate falls. The interest rate falls. And for a bond with a higher interest payments. Okay, the interest rate falls, the real investment, the reinvestment risk is higher. If the interest rate is increasing, then the reinvestment risk is lower. Okay, so it depends on how the interest rate changes in the future. Okay, so the reinvestment risk is subject to the bondholder who is reinvesting the interest payment. Reinvesting the interest payment. That's what we have seen, realized yield to maturity. We looked at realized yield to maturity, RYTM. We have seen that. How to calculate realized YTM. Okay. So any clarification, anybody so far? Then foreign exchange risk is only for foreign currency bonds. It is not for domestic bonds. It is only for foreign currency convertible bonds. Only for bonds which are traded in the foreign market. It is not for domestic bonds. So the foreign investment risk, foreign exchange risk is only for bonds which are denominated in foreign currencies. Because when you receive the interest payment, the exchange rate falls. What happens is you receive less money. So for example, the exchange rate increases, you receive a higher amount. See, for example, you receive, you have a American company bonds, you receive in dollars the interest payment. For example, you receive say $50, and the exchange rate is depreciating. The exchange rate is depreciating. See, for example, from the exchange rate from 76 to 78, it is depreciating. In such case, you get benefit because you receive more rupees. If it is appreciating, that is, for example, 76 to, you say, it becomes 74. So in such case, you receive less amount. If it is the interest rate, the exchange rate is increasing from say 76 to 78, for example, it is depreciating. You receive more dollars because you have $50. You get 78 rupees per dollar. You get benefited. The bondholder will get benefited. For example, it is appreciating. It is from say 76 to 74. So in such case, we receive less money. So the exchange rate, the changes in exchange rate. The changes in exchange rate affects the interest payment or interest receipt. So that is called foreign exchange risk. So if the bond has payment that are denominated in foreign currency, its rupee cash flows are uncertain because changes that depends on changes in foreign exchange rate. The risk that foreign currency will depreciate in relation to Indian rupee is referred to as foreign exchange risk or currency risk. So it depends on changes in foreign exchange rate. Okay. So it is only for foreign bonds. It is not for domestic bonds. So this particular risk, bondholder do not have any control over it. The company do not have any control over it. So they are called uncontrollable risk. So any clarification, anybody regarding controllable risk or non-diversifiable risk? Anybody has got any doubt? Then we have a controllable risk, that is diversifiable risk, which the company should have a control over it. very important risk that the company should have a control over it is the default risk. Default risk. Default risk means the company needs to pay its interest payment. The company needs to pay its interest. The company needs to pay the principal amount. The company could not pay it. The company could not pay its interest. The company could not pay its principal amount. That is called default risk. Default risk. So the company should have proper liquidity. The company should have proper liquidity to pay its interest amount and the principal amount. The default risk is the risk that the borrower may not pay interest or the principal on time. The borrower or the company may not pay its interest. The company may not pay its principal amount. That is called the default risk. The other things being equal, bonds which carry higher default risk may be sold at lower price. That is the difference. The government bonds may have a higher price because the default risk is zero. That's what we call it as a gilt-edged securities or government bonds. So government bonds, the interest rate will be lower. The interest rate will be lower and it will be sold at a very high price because the default risk is zero. Whereas the corporates, the companies have default risk. So those companies, those such bonds will have a higher interest rate, and those bonds will have a higher default risk. So a change in perceived default risk of a bond would have an immediate impact on its market price. Okay, so the higher the default risk, higher will be the interest rate and lower will be the price. Lower the default risk, lower will be the interest rate and higher will be the price. So when you look at the government bonds, the interest rate will be lower, but the market price will be higher. The corporate bonds, the interest rate will be higher because which are subject to default risk and the price will be lower. And when you look at Yes Bank, I just given an example here. Yes Bank, all of us know during the pandemic period, it was a very, very dramatic situation, and it was about to be closed because of some financial irregularities by the MD of a company and his associates. And the Yes Bank crisis has led to huge risk for new class of investors apart from retail investors and mutual funds, because it was about to close and now it got revived, and the MD and his team got into judicial investigation, and now the company is slightly reviving now. So they have issued additional Tier 1 bonds. We call it AT1 bonds, or also called perpetual bonds, issued by Yes Bank, will cause a loss of around 10,800 crore to their holders, since the Reserve Bank of India has proposed to writing down the AT1 bonds as part of restructuring process of Yes Bank. The entire AT1 bonds got restructured because RBI said the entire money needs to be paid back because the bondholders should not be at the risk. So what are AT1 bonds? The AT1 bonds are annual coupon bearing bonds which have no maturity date. So this Yes Bank has issued AT1 bonds. They are called the perpetual bonds. The interest rate on these bonds are higher than fixed deposit rate. This is how they attract the investors. They attract more investors to get more investment option. So these bonds do not have any maturity period. It's a perpetual. So the holders of these bonds can get their investment back by selling them in the secondary debt market unless the company redeems them. That is called the AT1 bonds, additional Tier 1 bonds. So additional Tier 1 bonds, bondholders were under very high risk when the company was in a huge financial loss. I'm talking about the month of April, May and June 2020. So then RBI has intervened, and the RBI said all these 81 bond holders need to be protected, and they have to pay their principal amount back. And all these 81 bond holders receive their money back. So it is called, that's an example for default risk. So the companies, these 81 bonds have got very high interest rate. Very high interest rate to attract the investors. I think they have issued at the 14% or 15% at the time to get more investors. So many have invested in that, but the bank got collapsed. The company could not pay its principal amount and interest payment. The RBI got intervened and it got settled. Okay, so the corporate bonds have a default risk, so they offer higher interest rate. So any clarification, anybody? Then we have a call risk. Call risk means at any point of time before maturity period, the company can call it back. The company can redeem it at any point of time before its maturity period. That's a call risk. So the bondholder has got that particular risk. The company redeems the bonds before its maturity period. So a bond may have a call provision that gives the issuer, that gives a company the option to redeem these bonds before its maturity period. The issuer would generally exercise this call option when the interest rate declines. When the interest rate starts declining, the prices increases. So they started redeeming these bonds. Okay. So while this is an attractive from the company's point of view, it exposes the investors a call risk. Okay. So since bonds are typically called for prepayment, after the interest rates have fallen, the investors will not find the comparable investment vehicles. So they don't find any investment alternatives when it is called back before its maturity period. Okay. So here investors are subject to call risk. So this is what different types of risk the bonds have got, which are broadly classified into controllable and uncontrollable. In controllable risk, we talk about interest rate risk. There's a relationship between interest rate and the yield and the price. And then we talk about inflation rate. That's the difference between inflation, higher inflation, and then you get a lower interest rate. And then real interest rate risk, that is the relationship between inflation rate and the nominal interest rate. And then liquidity risk, the bonds do not have a proper liquidity risk because it does not have proper secondary market. And then we have a reinvestment risk. When the interest rate falls, these bonds have lower option of interest rate. So the interest rate falls, they are subject to reinvestment risk. And then foreign bonds have got foreign exchange risk because it depends on changes in exchange rate. The exchange rate may get depreciated or appreciated. So in such case, these foreign bonds are subject to foreign exchange risk. And then in case of controllable risk, we have default risk and the call risk. The default risk, only the corporate bonds have got default risk, whereas the government bonds do not have a default risk because their default risk is zero. So such government bonds offer lower interest rate with a higher price, and corporate bonds offer higher interest rate with a lower price, because the default risk is higher in case of corporate bonds than the government bonds. So we looked at the example of Yes Bank, and then we have a call risk. For call risk is before the maturity period, the company can redeem its bonds. So in such case, when the interest rate is higher, when the interest rate is going higher, then the bondholder is deprived of getting their interest. So in such case, they don't find any other investment alternatives when the company redeems the bonds before its maturity period. So these are all different types of risk that we talk about. So any clarification, anybody with regard to any risk? Pavan Kumar. 3150. Pawan Kumar? Pawan Kumar is there?
Yes, sir.
Pawan Kumar. In case of government bonds, is there any default risk? Pawan Kumar? 3150. Pawan Kumar? Pawan Kumar? So Pawan Kumar is marked absent. Abhishek Kumar.
Yes, sir.
In case of corporate bonds, what's the relationship between default risk and corporate bonds? Relationship between corporate bonds and default risk.
Corporate bonds.
And default risk. So in corporate bonds, default risk is higher or it's lower.
The default risk is there, sir, in corporate bonds.
Okay, so what will be the interest rate?
Corporate
What will be the interest rate for corporate bonds?
interest.
For the corporate bonds.
Higher, sir.
Okay, so in case of government bonds, so what's the relationship between interest rate on government bonds and corporate bonds? Interest rate on government bonds and corporate bonds. The government provides more interest or corporates provide more interest?
Corporate, sir.
Why? Why should the corporate pay more interest than the government?
Because the risk is more, sir.
Risk is more. Okay. Gayatri, 3169.
Yes, sir.
When the foreign exchange depreciates,
Yes, sir.
foreign exchange risk, you receive more dollars, more rupees in terms of interest rate or less rupee in terms of interest rate.
When the foreign currency depreciates, sir. Less interest rate, sir.
Foreign currency depreciates. I talk about rupee depreciates. The rupee is depreciating. The rupee is depreciating from 76 to 78 or 74 to 75. So what type of risk the bondholder has got? What type of risk the bondholder has got?
Currency risk, sir.
Foreign currency risk. So you receive more rupees or you receive less rupees?
Less rupees.
Hello. You have $50.
Yes, sir.
The rupee is depreciating from 74 to 75. So you receive more rupees or you receive less rupees?
Yes.
You receive less rupees or more rupees?
Sir, in dollars we'll receive more, no, sir.
You receive more. Yeah, okay. Thank you. So thank you very much.